Hello and welcome. Thank you for joining another session of the My Solo 401k Financial, My Community daily webinar series. I see that we've already got a question. Thank you so much for bringing the question. We'll turn to that in just a moment. Just take care of some quick housekeeping. So, as always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. We're excited today to discuss keep more of what you earn, the $83,250 Altruist Solo 401k strategy. So before we get into those topics, though, we do want to field the question from Michael. Thank you for bringing it, Michael. We also just want to remind you that this is the second session of the day. We had a session earlier. We go live generally twice per day with Q&A sessions. So we always want to use this as an opportunity to answer the questions that you have or cover the topics that you want to discuss, in addition to the content that we come to share. As always, our goal with these sessions is really just to help you build your retirement future, secure your retirement future. So to help us help others like you, if you could please like this video, whether you're on LinkedIn or Instagram or YouTube or X, as that's going to help us get the word out to other solopreneurs, other advisors like you who might be also looking to stop overpaying taxes and start building real retirement wealth. Again, this is your chance to get answers. Please use the chat now so that we can be sure to get to them all. All right, so with that, let's field Michael's good question. Can a person have multiple Schwab accounts for their solo 401k Roth? The reason is for different investment models, strategies. Would like them in separate accounts for tracking performance purposes. I assume yes, but just wanted to get confirmation in the event I'm missing something. The answer is yes, provided that the accounts are opened up under the name and EIN number of the plan. It's actually not uncommon. Specifically with our clients, what we oftentimes see is a customer will have both bank and brokerage accounts. For example, they may have bank accounts to facilitate their alternative investments and brokerage accounts to facilitate their brokerage type investments, and then move money between the two types. So, for example, between a real estate deal, they may want to put money into a mutual fund or a money market. And so when you move money like to like say Roth bank account to Roth brokerage account, that's not taxable. It's not reportable. It's really just moving money between accounts for the same plan. So you're not moving it out of the plan. Again, not taxable, not reportable. Now, with that same logic, you could definitely have multiple, say, brokerage accounts for the reasons that you mentioned, whatever good reason you have, as long as each account is opened up under the name and EIN number of the plan. Thank you so much. So if there are other questions or topics you want to discuss, again, please chat it over now so that we can be sure to get to them all. Now let's go through some of the slides around keep more of what you earn, the $83,250 Altruist Solo 401k strategy. As always, it's good to start out with an eligibility discussion, just to clarify who's even eligible to set up a solo 401k. So in order to be eligible, there's two requirements as part of that eligibility foundation. One is self-employment activity, and there's flexibility there. In other words, you don't have to be self-employed under a formal legal entity. You could operate as a sole proprietor without a formal legal entity, or you can have a formal legal entity like an LLC. Could be an LLC taxed as an S corp, or a corporation taxed as an S corp. Could be a partnership. Ultimately, the key is that you are reporting earned self-employment activity to demonstrate that you're self-employed. So, for example, For a business that's taxed as a sole proprietor, earned self-employment income is going to be income reported on Schedule C of your 1040. Whereas if your business is taxed as an S corp or a C corp, earned self-employment income would be W-2 wages that you receive from your business, taxed as an S corp or a C corp. Finally, if your business is taxed as a partnership, earned self-employment income is income reported on line 14 of the K-1 that you receive from the partnership. Now, the other piece of the eligibility equation is that it needs to be an owner-only business. That means that you cannot have any non-owner, non-spouse, full-time W-2 employees, where a full-time W-2 employee is someone that's age 21 or older, who's either working 1,000 hours per year with a year of service or 500 hours per year for 2 consecutive years. Now, that means that you can't have a spouse. Yes, you can have a spouse that's working in your business. You can have another owner that's working in the business. As long as the spouse is reporting their own earned self-employment income, and as long as the other owner is at least a 3% or more owner, and it's still going to be considered a solo 401k. Now, it's helpful to understand what a solo 401k is. A solo 401k is really a legal entity. It's a retirement trust. And like any legal entity, it's the documents that create it. So my solo 401k financial is a 401k plan provider. So that literally means we're a document provider. We have IRS approved plan documents that we use to create a solo 401k plan for our customers. And then our customers, along say with their advisors, if they're working with an advisor, will open up accounts for that solo 401k plan. Now, we're very hands-on in helping customers open up accounts, and that could be, for example, at Altruist. Altruist is a platform for financial advisors. So we're fortunate to work with a number of advisors who custody at Altruist. In other words, they have their accounts for their clients at Altruist. So you can certainly open up a solo 401k plan with my solo 401k financial, but still work with your advisor that custodies at Altruist. So the account can be at Altruist, but we can be the plan provider. So why would you want to work with us and still have your account at Altruist? Well, our solo 401k plan is going to provide all the advanced features that you and your advisor might be looking to take advantage of. So, for example, one of the most popular features is the ability to make mega backdoor Roth solo 401k contributions. So, in short, with a mega backdoor Roth solo 401k contribution, the solopreneur is going to be able to contribute a much higher amount where the funds end up in a Roth account. So, for example, for 2026, if that individual is age 60 to 63, they could be making contributions where $83,250 will end up in their Roth account. Another great feature that's available with our solo 401k plan documents, where your accounts are at Altruist, is the ability to take a 401k participant loan. So that's another popular feature because now the solopreneur can access money. They can be their own bank. They can withdraw money from their solo 401k and use that for any purpose. Could be a business purpose, could be a personal purpose, and that's not going to be subject to taxes. It's not going to be subject to penalties as long as it's within the terms of a solo 401k loan, documented as a loan, and paid back according to those repayment terms. So those terms are going to provide that the loan is limited to no more than 50% of the balance, not to exceed $50,000. It needs to be paid back in either monthly or quarterly payments. It's up to the solopreneur. Equal payments of principal and interest. The interest is either prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. And then it also needs to be documented as a loan. So we, as the solo 401k plan provider, we prepare the loan documents and we don't charge any additional fee for that. Customers or their advisors would just need to let us know when they're ready to take a loan, and then we'll prepare the loan documents within one business day. Another great feature to mention that's very popular with customers and their advisors, the custody at Altruist, is the ability to claim $1,500 in solo 401k tax credits. That's $500 per year for 3 consecutive years. So my solo 401k Financial was the first solo 401k provider to offer a plan that's eligible for the tax credits. We offered the plan starting at the end of 2023, really the beginning of 2024. So the last part of December 2023. So that tax credit, or really those tax credits, because again, it's $500 per year for 3 consecutive years, is available to a solopreneur that sets up a plan like the one offered by my solo 401k Financial that comes with an auto enrollment feature. So this could be available for both a new plan as well as an existing plan that's upgraded to our plan. So we're automatically going to draft the plan documents to include the required feature, the required notices, so that now the solopreneur can claim those credits. So those credits are going to more than cover our fees for the first 7 years. We charge $650. That's the initial cost. That includes the $525 establishment fee plus the first $125 annual fee. Starting 12 months later, we charge our $125 annual fee, and it's totally flat, regardless of the value of your account, regardless of the services needed, whether it's helping with the mega backdoor Roth, the loans, the 5500 EZ, right? Once the value of your plan exceeds $250,000, including the value of any defined benefit plan that you might have, there is an annual informational tax filing requirement. The name of that informational tax filing form is Form 5500 EZ. So we prepare that 5500 EZ. We prepared it in the electronic filing system to make it easy for the customer and the advisor. Now, since we don't have access to the accounts, we just need to be notified once the value exceeds $250,000. Then we'll add the plan to the queue to take the client through that 5500 EZ filing process, where again, we end up filing it through that electronic filing system to make it easy for all parties. Now let's understand how one's going to be able to contribute potentially up to $83,250 for 2026. So I think it's helpful to understand that there's different buckets that the solopreneur can contribute to. Right? In the words of the IRS, the solopreneur is both the employee and the employer. And because it's able to fill up different buckets, as a matter of fact, the solo 401k has the highest contribution limits available for any defined contribution plan available to self-employed individuals. So the first bucket to discuss is the employee bucket. So as a solopreneur, the solopreneur can make employee contributions to the solo 401k. The 2026 solo 401k employee contribution limit is 24,500. Now that limit goes up once the individual is age 50 or older. So now they can start to make what's called catch-up contributions. So the catch-up contribution limit for those age 50 plus is $8,000, but then there's an enhanced catch-up contribution limit of $11,250 for 2026 if the solopreneur is age 60 to 63 during 2026. So those are all employee contributions. And then on top of that, they can make the solopreneur, the self-employed individual, can also make employer contributions because again, they're both the employee and the employer. Now that employer contribution limit is a percentage of their self-employment compensation. If your business is taxed as a sole proprietorship, could be a single member LLC, taxed as a sole proprietorship, that limit is 20%. Whereas if your business, for example, is taxed as an S Corp or a C Corp, that limit is 25% of your W 2 wages. And then, of course, the overall limit is $72,000, but that doesn't include the catch up. So that's how you could potentially get up to $83,250 if you're age 60 to 63. So breaking down the employee contribution and understanding that a little bit more. Again, the standard limit is 24,500. If you're age 50 plus, you can also make additional catch-up contributions. Now, with our plan, with the plan offered by my solo 401k Financial, it allows for tax diversification. So that employee contribution could be made as a pre-tax contribution. where it reduces your taxable income now for the year for which you make the contribution. Or it could be made as a Roth contribution. In other words, on an after-tax basis, where it's not going to reduce your taxable income now, but you've got that potential for tax-free growth. So some clients will do all pre-tax, others will do all Roth, others may alternate between years, and some may do a mixture of pre-tax and Roth. Now, any type of contribution that you make to the solo 401k, you need to have the income to justify it, right? You can't save more than you earn. So it would be limited by your earned income or W-2 wages, depending on how your self-employed business is taxed. It's going to count towards that $72,000 overall limit. Now, what doesn't count towards the $72,000 overall limit are the catch-up contributions. So again, if you're age 50 plus during 2026, that catch-up contribution limit is $8,000, and then it's enhanced up to $11,250 if you're age 60 to 63. Now, it's noteworthy that per Secure Act 2.0, if your W-2 wages are over the applicable amount, $150,000 for 2026, those catch-up contributions have to be made as Roth contributions. But it's noteworthy that if you don't receive W-2 wages, let's assume that your business is taxed as a sole proprietorship and you don't pay yourself a W-2, then even if you have a high amount of self-employment income, that Secure Act rule is not going to mandate that you make those catch-up contributions as Roth contributions. You still could, but you wouldn't have to based on the Secure Act 2.0 rules. Then again, let's dive deeper when it comes to employer contributions. So all types of contributions that you make need to be based on earned self-employment income. What earned self-employment income is depends on how your business is taxed. So if your business is taxed as an S corp or a C corp, your earned self-employment income are the W-2 wages that you receive from the S corp or the C corp. In that case, the employer contribution limit is 25% of the W-2 wages. Whereas if your business is taxed as a sole prop or a partnership, you need to run a pre-calculation. And we help our customers with these calculations every single day. We have a calculator on our website that also run the numbers. But you, again, need to run a pre-calculation. That pre-calculation, if your business is taxed as a sole proprietorship, is your net income reported on line 31 of Schedule C, less one half of the self-employment tax. If your business is taxed as a partnership, that pre-calculation is the income reported on line 14 of the K1 that you receive from the partnership, less one half of that self-employment tax. And then of that number, you can contribute 20% as an employer contribution. Now, it's noteworthy that the employer contribution limit does count towards the overall limit. So the sum of employee, employer, and any voluntary after-tax contributions that you make to the solo 401k cannot exceed the lesser of your self-employment compensation, because you can't save more than you earn, or the overall limit, which is $72,000 for 2026. It's also noteworthy that, yes, technically you can make employer contributions as Roth contributions now, thanks to the Secure Act. But in our experience, it's very rare, almost unheard of, that our customers will make employer contributions as Roth contributions. Why? Because their plan already allows for mega backdoor Roth contributions. And it's simpler from a reporting perspective to make a mega backdoor Roth contribution. And it's easier to hit the overall limits. In other words, you don't need as much income, right? Because with employer contributions, you're limited to just a percentage of your self-employment compensation. So you'll need more income to justify the contribution that you want to make compared to just simply making voluntary after-tax contributions, which is how one makes mega backdoor Roth contributions, because the voluntary after-tax contribution limit is 100% of your self-employment compensation. So it's not a percentage. So that voluntary after-tax contribution limit, that will count towards the overall limit, the $72,000 limit for 2026. You can make those contributions as a waterfall approach. So some customers will first fill up their employee, then fill up their employer, and then whatever's left, if they have the income to justify it and they're willing to make those contributions, will make any additional contributions up to the overall limit as a voluntary after-tax contribution, whereas some will just take an only voluntary after-tax approach. In other words, they'll skip employee, they'll skip employer, and they'll just make after tax. And that's totally fine. Now, making a mega backdoor Roth contribution is a two-step process. So that mega backdoor Roth strategy really involves first making a voluntary after-tax contribution, because the voluntary after-tax contribution limit is so much higher than the Roth limit, right? Right. We saw with the employee contribution limit slide that it's limited to 24,500 or more if you're age 50 or older. But with the voluntary after-tax contribution limit, the solopreneur can contribute 100% of their self-employment compensation, dollar for dollar, up to $72,000, assuming they don't make any other contributions to the plan. So the limit is so much higher, but you want to then get the funds into a Roth account. So that's where that step two comes in, to then transfer the funds from the voluntary after tax account to a Roth solo 401k inside the plan, or out of the plan to a Roth IRA. Why? Why do you want the funds in the Roth account? Because now they're going to act like any other funds in a Roth account where you've got that potential for tax-free growth. So then customers will then invest via the Roth account with, again, that potential for tax-free growth. Now, the foundation is the documents. You need to have a solo 401k plan like the one offered by my solo 401k financial that allows for both steps that are required to make a mega backdoor Roth contribution. So the plan documents that both allow for the voluntary after-tax contributions and then the in-plan conversion either to a Roth solo 401k or the transfer out of those voluntary after-tax solo 401k funds to a Roth IRA. So here's a quick example about how someone might reach $83,250 in 2026. Let's assume that they're age 60 to 63. Let's assume that they're not making contributions to another plan like a day job plan. So they first contribute 100% of their self-employment compensation up to 24,500 as an employee contribution, right? Let's assume they have $100,000 in self-employment compensation. Then they contribute a catch-up contribution because they're age 60 to 63. That's equal to $11,250. Then they contribute 20% of their self-employment compensation, $20,000 as an employer contribution. Then they contribute the difference as a voluntary after-tax contribution. So that difference is 27,500. So at the end of the day, this individual with $100,000 of self-employment compensation would have saved $83,250 in their solo 401k. But let's assume they're not 60 to 63. Let's assume they're, say, 55. That same person could end up contributing $80,000 to their solo 401k if they have the self-employment compensation justify it. So the contribution opportunities are tremendous with the solo 401k. You do, again, need the plan that's going to allow for all these different contribution buckets. The great thing about my solo 401k financial is it's totally portable. So if you're working with an advisor that custodies the Altruist, you can most certainly have the accounts at Altruist, but have the plan provided by my solo 401k financial. Other key takeaways we discussed is the overall limit, the $72,000 limit. That applies to your standard employee, your employer, and your voluntary after-tax contribution amounts. But the catch-up contributions for those that are age 50 plus, whether it's 8,000 or 11,250, that's on top of the 72. That's how you could potentially get to 83,250 if you're age 60 to 63. And then again, if you want to take advantage of the advanced features, the tax credits, etc., you need the plan like the one offered by my solo 401k financial that supports those features. Okay, so wonderful. Now let's, before we keep going with some more slides, let's field some more questions. Thank you so much for your patience as we went through that. And again, we'll just ask you real quick, if you could like the video, that's going to help us get the word out to others like you. Tells the platform that the content is valuable. We also invite you to subscribe to our channels, whether you're on LinkedIn or X or Instagram, so you get notifications of when we go live. We go live every day with crucial content to help you secure your retirement. So back to Michael. When does my solo 401k reach out for 5500 EZ from the client? So we reach out in the spring. So we've already started to reach out for the plans that are due by July. So if you're an existing customer, you can just email support if you haven't heard from us, and we can send you the online form link that we're using to pull that information, to capture that information from clients and their advisors. And if you're already on the list, we'll also be audit. So if we helped you file the 5500 EZ last year, then we'll reach out to you automatically. You don't have to remind us if we helped you file it last year. But again, if you're ready to give us the information, just email support@mysolo401k.net and we'll email you a link to the questionnaire for this year. Now, for those that might be looking to set up a plan, again, it could be a new plan or it could be an existing plan that's being upgraded. It's very common that customers will start out with the basic plan and now they want to start to take advantage of the more advanced features. So it's very easy. Just go to mysolo401k.net, click on open account. Could be you, could be the advisor on behalf of the client. It's 10 simple questions. That's how we gather the information that we need to prepare the documents to establish the plan. So once the application is submitted, payment is made, we prepare the documents within the same business day. Now, if you're working with an advisor or if you're an advisor submitting on behalf of a client, what our clients and their advisors, what many of them find works well is that we copy the advisor. And so when that application is being submitted, a very simple process to be copied would just be to just include the name and email address of the advisor when responding to that last question on the application. The last question asks for the name of the plan. We recommend 2 words in the word trust, but it's a totally free form field. So additional notes can be added. So you could add, for example, XYZ Wealth Trust, please copy the name and email address of the advisor. Then we'll copy the advisor on communications. And then again, once the application payment is made, we prepare the documents within the same business day. An email would go out to the client, copy to the advisor. We also want to invite you to our community. We do have the largest community of solopreneurs, solo 401k advisors, just interested parties, folks that are interested in these topics. With over 30,000 members, we have vibrant forums. We have a library of videos and webinars. So there's a ton of ways to learn, a ton of ways to share the knowledge. And it's totally free to join. All are welcome. It's not just limited to clients, not just limited to advisors. You can join quickly and easily at mysolo401k.net/my community. So please don't hesitate to join. It looks like that's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.